Welcome, everyone, and thank you for joining today's Extractive Sector Transparency Measures Act, or as we'll be referring to, ESMA, throughout this webinar. My name is David Whiteley. I'm a partner with the Accounting Advisory Services practice of PwC, working here in Calgary. My main focus is on regulatory compliance and on performance management. I have over 15 years of experience both in the regulatory consulting practice as well as serving as a CFO in the oil and gas industry in Alberta. I'm going to talk a bit about and introduce our speakers. Our first speaker is Scott Bandura. Scott is a partner in PwC's National and Global Accounting Consulting Services and is also working in the Calgary office. Scott has significant technical experience in international financial reporting standards, U.S. GAAP, Canadian GAAP, and has specialized in the extractive sectors. Also speaking is Stacey Hammett. She's a partner in PwC's National Assurance, Quality, and Methodology practice in Toronto. Stacey is responsible for supporting engagement teams during regulatory reviews across Canada and working with senior leadership in the development of the overall strategic plan to maintain quality. Our final speaker is Kelly Ohoyan. She is a partner in PwC's Forensic Services Group in Toronto and the forensics leader for the mining sector. Kelly specializes in the assessment, development, rollout, and training of anti-bribery and corruption compliance programs. She also assists clients with remediation efforts following incidents of fraud, bribery, and corruption incidents. Before we start the session, we have a few reminders. At any point during the presentation, please feel free to submit a question by typing it into the Q&A window on the lower left hand of your screen and then hitting the Submit button. We will attempt to answer as many questions as possible during the Q&A session at the end of all the presenters. For any technical issues, hit F5 to refresh your screen on the PC and Command R if you're using a Mac. If you have technical issues, click on Help and at the button at the bottom of your screen, or use Ask a Question feature to describe your problem. I'm going to draw your attention to a quick disclaimer. It is important to note that we are not intending to provide legal advice throughout this webinar. As auditors and accountants who may be asked to attest to information under the Act, we have to obtain an understanding of the rules and thought it would be useful to share with you our current understanding. Entities should consult with legal counsel for legal interpretations. The rules for reporting payments continues to evolve, and entities should also look for updated guidance from the Ministry of Natural Resources. Now I'd like to tell you a little bit more about today's presentation. Today's discussion is going to focus in on the following topics. Scott will provide an overview of regulation and update us on the focus in industry group discussions that have currently been held. And next, Stacey will walk us through attestation requirements. I will then provide an outline of the key challenges and considerations in relation to starting a compliance project such as this one. We'll conclude with Kelly, who will talk about the anti-bribery and corruption, as there is some parallels to that legislation. Now I'm going to hand it over to Scott, our first speaker, who will provide an overview on regulation and update on focus and industry group discussions. Scott?
Thanks, David. Yeah, so we'll jump right into a brief overview of the standard. Sorry, just scrolling to the correct slide here. Yeah, so an overview of the standard. So it's important to note sort of the background of the standard and where it came from, because there's been a lot of lobbying of governments around the world from groups such as Publish What You Pay for extractive sector companies to disclose payments to governments. And the objectives of such group is really to increase transparency of such payments, especially to governments of developing countries, in order to deter corruption in those nations. And if you look at a group like Publish What You Pay, they state this on their website and say, we campaign for natural resource revenues from company to state to expenditure to be transparent and tracked so that citizens can hold their governments to account for how these are spent. So in that vein, Canada, along with other G7 countries, including France, Germany, Italy, Japan, the UK, and the United States, agreed to participate and create legislation to provide for payments to governments to be reported. In the UK, this is already being implemented currently, and in the US, this was under the Dodd-Frank legislation, which the SEC is currently working on a new rule to create the reporting guidance for. But Canada has issued the Extractive Sector Transparency Measures Act, and in the preamble to that act, it says explicitly that this is to implement Canada's international commitments to participate in the fight against corruption through the implementation of measures applicable to the extractive sector. So in terms of a timeline as to how this arose, there were various discussions by the G7 and G8 countries over time. And in June 2013, the Prime Minister of Canada announced that Canada would adopt the revenue transparency type disclosure. And in December 2014, an act, the Extractive Sectors Transparency Measures Act, was actually enacted and received royal assent. The act has not yet come into force, so the act will come into force by an order in council. We expect that the act will likely come into force in around June of this year, so sometime mid-year 2015. And assuming that the act comes into force in 2015, we think that it's likely that the first calendar year for a calendar year company that will require reporting is the 2016 calendar year. So the reporting is based on a company's financial year end. So throughout the presentation, we'll basically assume that companies have a calendar year end. So in a calendar year end company, 2016 is likely the first reporting year, so the first period on which payments will have to be reported on. A company will have 150 days from its year end in order to file the report. So 150 days from December of 2016, that would be around May 2017 that the report will be due. In the Act, there's a discussion of payments to Aboriginal governments, which is a bit unique to Canada because Canada has Aboriginal groups that are self-governing groups, and the Act provides for a deferral for reporting of payments to those Aboriginal groups for 2 years. So it's likely 2018 would be the date when those are required to be reported. In terms of the scope of the legislation, it's quite broad. So basically the Act will apply to entities involved in the commercial development of oil and gas or minerals that are listed on a stock exchange in Canada. So essentially all public companies will be within the scope of the Act that are involved in these commercial development of oil and gas or mineral activities. So public oil and gas and mining companies will be within the scope, but a lot of private companies will also be within the scope, because the other condition is that if a company has a place of business in Canada, does business in Canada, has assets in Canada, and based on its financial statements meets at least of the two of the following conditions, it will be within the scope of the Act. And those conditions include that it has at least 20 million in assets, it has generated at least 40 million in revenue, or it employs an average of at least 250 employees. So a lot of private extractive sector companies will fall within the scope of the Act because they'll meet one of those two of those three criteria. So what are the basic requirements of the Act? Well, the Act requires that companies file a report with the Ministry of Natural Resources, and we expect that the report will be placed on the company's website to report payments to governments within 150 days of a financial year end. So important to note, we don't think that there will be a central repository for these reports. We think that each company will likely have to report itself on its company website. The report has to include an attestation made by a director or officer of the entity or an independent auditor or accountant. And that attestation should say that the information in the report is true, accurate, and complete. We'll talk a little bit more later in the presentation about the attestation requirements. Important to note as well that the definition of government in the Act includes any government in Canada, federal, provincial, municipal, or any foreign government. So the reporting is for both Canadian government payments and also payments to foreign governments. For foreign governments, an entity would have to look at how those foreign governments are organized and whether there are multiple levels of government similar to Canada. It also covers bodies established by two or more governments or other bodies that perform a power, duty, or function of government. So this would include things like commissions or boards, etc. And as discussed, it also includes payments to Aboriginal governments or Aboriginal-related bodies. So how will this report work? This is an illustration. It's not necessarily the reporting format that will be used, but this is meant to illustrate the type of information that will have to be reported. So what is required? Payments reported by project, category, and government. So essentially, there are multiple levels of reporting here, and we've tried to demonstrate this in a simple example where a company only has payments, let's say, to the federal government of Canada and the government of Alberta. Obviously, if a company has more different types of government payments, it could have more columns because the requirement is to report all the different payees separately. And also, the information has to be reported by project. We'll talk a little bit more about what a project is later in the presentation. And in addition to by project, the information has to be reported by category. And there are prescribed categories in the Act. So we've put a few examples up here, including royalties, taxes, fees, and infrastructure. But actually, there are quite a few more categories listed in the Act. So you can see that the reporting requirements are quite detailed in the Act. And we do expect the format of the report may evolve over time. Likely the Ministry of Natural Resources will provide more guidance on exactly how to format the report, etc. And as I say, our example there was really just to illustrate the types of reporting that would be required for various payments. So that was a brief overview of the Act. I'll move on to some discussions that have been had and what we've heard through some industry focus groups and about various aspects of the reporting under the Act. So the first one I'll talk about is the definition of a project. So the definition of a project is not given explicitly in the Act, but the Act does say that payments by category and government will need to be reported by project. So because there's no specific definition in the Act, it's likely some judgment will be required. For an oil and gas company, if you think about a conventional oil and gas company in Canada, they might have, let's say, tens of thousands of wells in some cases. So obviously reporting at a well level as a project would be very, very onerous. We do expect that for an oil and gas company that a project will be defined as something greater than a single well, but probably less than the entire country. And likely it'll be something consistent with an entity's internal reporting, for example, how a company views itself for segments or cash-generating units. So likely there will be some level of aggregation required, and as mentioned, judgment will be required as to how an oil and gas company would aggregate projects in that way. For a mining company, projects are probably, by their nature, easier to define. So if you think about a simple mining company, it might have 3 distinct mines, for example, and probably those would be identified as projects. However, obviously complexities could arise depending on how the entity is organized. The Act talks about the commercial development of oil and gas or minerals, and questions have arisen as to how broad the potential scope is of the Act and whether it relates to activities incidental to the extraction of the related minerals. So, for example, would it apply to development of infrastructure to transport extracted oil and gas? Would it apply to things like camp setup for a mining site? We do think it's likely that extraction will be defined more narrowly to be the actual costs incurred to physically extract product and not to incidental activities associated with the selling of products like refining or transporting. But again, additional guidance will likely come out from the ministry on this, and entities should be following that guidance and seeing if there are any specific examples provided. The next section is on controlled entities, and this is a bit of a complex section in the Act. So first of all, the Act applies to entities, and entities in the Act are defined as corporations, trusts, partnership, or other unincorporated organizations engaged in the commercial development of oil and gas or minerals in Canada or elsewhere, or that controls a corporation or a trust, partnership, or other unincorporated organization engaged in the commercial development of those oil and gas or minerals in Canada or elsewhere. And control is defined in the Act very broadly to say an entity is controlled by another entity if it is controlled by the other entity directly, indirectly, in any manner. And an entity that controls another entity is deemed to control any entity that is controlled or deemed to be controlled by the other entity. So it's a bit of a mouthful, really. We'll go through an example in a second to try to illustrate this. But likely, a Canadian entity will need to report payments made by other entities, Canadian or foreign, that it controls or is deemed to control. And the definition of control, as we just went through, is somewhat vague in the Act. We think the most likely outcome is that control will be aligned with an entity's reporting framework. So likely the first step will be to look at what entities are consolidated under the company's financial reporting framework. But again, interpretation of that may evolve over time. The other question that arises is joint operations. So there can be situations where multiple parties have a joint arrangement through ownership of undivided interests. So these are situations where it's not conducted through a legal entity to develop an oil and gas project or a mine. So often in oil and gas, we refer to these as working interest transactions. And in working interests, typically there is an operator that's designated to deal with the day-to-day extraction activities and make payments on behalf of the working interest holders. We think that it's likely that the operator in such situations will be required to report the payments on behalf of all the working interest holders. And practically speaking, that seems to be the only logical solution, because it would be very difficult for a non-operator to have the information to do the reporting. So let's look at an example. So here we have a simple example structure of a Canadian parent company, and they have various subsidiaries and investments, which we'll go through in a second. So first of all, the Canadian parent company, if it itself is engaged in the development of oil and gas or minerals, will have to report payments made at the parent company level. And then it will have to look at other entities which it controls or is deemed to control. So looking at this example, Canadian parent company has an interest in subsidiary 1 and subsidiary 2. Subsidiary 1 is a U.S. company, subsidiary 2 is Australian. So the Canadian parent company will likely have to report payments to governments by both of those first-tier and second-tier subsidiaries. The parent company also has an investment in a joint venture company in the Philippines. In this situation, we're assuming that it has a 50-50 ownership, and neither it nor the other party controls the joint venture company. And we're assuming as well that the joint venture company operates on its own, so it's not operated by one of the parties. So likely that will not be a controlled entity for purposes of the analysis of reporting. So in that case, the payments made by that joint venture company wouldn't necessarily be reported by the Canadian parent company. There's also a working interest held, a 40% working interest, undivided interest in an oil and gas property or a mining property. And here we're assuming the 60% working interest holder is the operator, so it's not operated by the Canadian parent company. In that case, again, we think it's likely the operator of the working interest would be the one to do the reporting. Finally, there's an associate held by the entity that operates in China. So in this case, it's owned 25% by the Canadian parent company. In this situation, we're assuming that there's no control exercised by the Canadian company over that associate. So the payments made by that associate are likely out of the scope of the Canadian parent company's reporting. So obviously this is a simple example. In practice, it could be much more complex, the organizational structure. Another question is about infrastructure payments. So often entities are required to make certain payments in kind to governments in order to obtain extraction permits, for example, building schools, roads, or other local infrastructure. Building of infrastructure to obtain a permit for extraction, which is controlled by a government, would likely need to be reported at its cost, or a fair value of cost isn't determinable. If other infrastructure is developed purely to obtain access to wells or to a mine and is controlled by the entity doing the extraction, for example, until the extraction project is complete, likely this would not be reported until handed over to the government. So an example would be an access road to a mine where the mining company controls fully the access road until the mine is abandoned, for example. So if it's used, specifically for the project and is not controlled by the government, likely it wouldn't be reported until it's handed over at that point at the end of the life of the project. There could be judgment required in some cases where shared infrastructure is developed as a condition of a permit. So simple example, let's assume a 20 megawatt power plant is required to service a mine, but a 50 megawatt plant is built as a condition of a development permit. And the excess power is required by the government to be sold to the local community at the cost of fuel. So in that situation, the infrastructure might be considered partially to be used for the mine itself, but it's partially required as a condition of obtaining sort of the license and providing a benefit to the local community as directed by the government. So there could be complex situations like that where probably it's necessary to do a little bit more analysis and discuss with legal counsel in particular, etc. The Act also contemplates third-party payments. So basically the Act says a payment that is made for an entity is deemed to have been made by the entity. So questions have arisen as to how this would be interpreted and whether it would be broadly interpreted to mean that payments by a supplier to a government would have to be reported. So let's say, for example, you're buying extractive equipment from a supplier, and that supplier has made payments to the government for taxes, etc. The question is, would the Canadian reporting entity need to report payments made by the supplier? Would those be paid on behalf of the company? We think it's likely that the guidance will be more narrowly interpreted to relate to payments made directly on behalf of the entity. For example, where the entity has hired agents to act on its behalf in procuring licenses or lands. So more of a direct agency relationship rather than a broad scope. However, again, this is something that continues to evolve, and you'll have to continue to monitor any further guidance provided by the Ministry of Natural Resources. Okay, so now I'll turn it over to Stacey to talk about attestation requirements under the Act.
Thanks, Scott. So as mentioned by Scott earlier, there is an attestation requirement. So the first thing that I just want to highlight is what the actual requirement is in the Act. So, there's two key things here. One is, that it's made by a director, officer of the entity, or an independent auditor, which I'm going to talk more about. And the other is that the report is true, accurate, and complete. So with respect to true, accurate, and complete, what I really wanted to highlight is, well, what does this mean? True, accurate, and complete is a higher standard than is currently required under 52109. And it's also important to note that there are potential fines for non-compliance. These are cumulative and they're per offense per day. So, that could accumulate to a very significant amount. And then the other thing is that the ministry may request an audit. So they don't need to, but, there is the option that they could. So as we're looking at the attestation requirement, what we really wanted to highlight is that currently the way it's written, Canadian generally accepted auditing standards do not cover the attestation requirement. So, what does this mean? We still can help, and we have had preliminary discussions with the Ministry of Finance, to let them know what the options are. So support still can be provided to management, and that's really important because, given the level of accuracy that's expected by the ministry, engaging an independent accountant would help support a due diligence defense, that you have taken the appropriate actions to make sure that, you are meeting that true, accurate, and complete standard. So what I've listed is some of the options in the way and what we can do. So the first one is an opinion under Canadian Auditing Standards, which is CAS 805. This is very similar to an annual financial statement audit, but would be obviously at a much lower level of materiality given the level of precision that is required by the ministry. And generally we would expect this to be a combined approach where we would look at controls around the process supported by additional substantive testing. And then, the next level of assurance down would be Section 8500. So this is a review of financial statements. So again, this is very similar to, what we would typically do in a quarterly review and would consist primarily of more analytical procedures. And then the next two that I'm going to talk about, these are two things that are still options but are less likely to be acceptable by the regulator because wouldn't really meet the auditor requirement and they're not actually providing any assurance. So the first one is the Canadian Standard for Related Services. So this is a new standard, 4460. It's not currently in effect, but there is the ability to early adopt that. On initial look, it seems like something that would be highly relevant because it does talk about, where additional information is required, financial information. But because it actually doesn't provide any assurance, we don't think that that's going to meet the needs of the regulator. And then the last one is Section 9100. So this is specified auditing procedures. So again, that doesn't have any audit assurance per se, so it may not be acceptable for the ministry if they haven't defined the procedures, but could still be helpful for management as part of their due diligence if directors or officers wanted some additional comfort that things have been completed properly. And then, like I said, we have had preliminary discussions with the natural resources, and we have discussed, the concern about the reference to the auditor, et cetera. And our expectation is, in the event that an audit was requested, that they would be comfortable accepting an opinion that would be issued under CAS 805, which covers financial information. Okay, and I will now pass it back to our host, David Whiteley.
Thanks very much, Stacey. We've actually, through the course of reviewing the legislation and discussion with clients and industry groups, we've actually developed some questions which we thought would be helpful to share with the audience. So Scott's going to kind of walk us through a few of those questions, and what we've tried to do is kind of put this in the context of how we would help companies maybe go through a project like this. So I'm going to take you through that, and Scott's going to deliver some of these questions. Scott?
Sure. So I guess the first question is a broad one. How should an organization prepare and plan to adopt the Act? And what should a company do to assess what the Act really means for it specifically?
So, the first part of any plan is really the understanding of the Act itself. And, as you took us through some of the complexities that we've seen so far, we can see that there was many definitions that need to be understood. There's many judgments that certain companies, so hopefully that was a good start. The second thing I would say is that ISMA is going to require a specific response and reporting responsibility for each company. Although companies may belong to the same industry and will have common elements which will apply to them regarding industry-wide government payments, we would emphasize that each company is different. A good example was that slide you showed on the types of corporate structure that will impact what you have to report, as well as the countries that that you operate in, the nature of the assets held, all could be different by every company and can impact the nature and timing of government transactional payments. Understanding each company's uniqueness and then how to conduct itself with government entities is a good place to start. So the second thing to do is what we would recommend is conducting a risk assessment of not only the companies under your consolidation, but also the countries of where the company operates to determine whether there is what we'd characterize as identification risk of a payee or a payment to a government entity. I think Kelly is also going to identify some leading practices relating to this issue, as well as operating in foreign jurisdictions and dealing with foreign officials.
Thanks, David. So I guess the next question is really then, how should an organization determine specifically what payments are applicable to report?
There's two key components to this, Scott. The first is the who, identifying which government payees or aboriginal bodies that apply to the company. And then the second is the what, identifying the types of payments to these bodies that are applicable. So the questions you should be asking yourself is, how do these government entities or agencies actually become a payee of the company? And when do they become a payee? Who authorizes that payment? And are they permitted to be a payee of the organization? Are they a direct entity or an indirect entity for a payment? This is a critical identification step because the project needs to be focused around capturing all the payments being made, or as we'd like to refer to this as the principle of completeness. As we heard from Stacy, the penalties for omissions are significant, so payment and payee identification is going to be critical for this project. So this gets me to three key tips on identifying the payment universe. The first one is for an extractive industry company. I would recommend that you kind of go through a life cycle of maybe a typical project that you would have. Think about from, dealing with from a prospecting or an evaluation stage, from a piece of land, right through the exploration and production, and then to the eventual remediation and reclamation of that property, and identify the various payments that are made through those stages of the life cycle. This should take you through all the payments which are currently exist, and give you a good understanding of how your company does business, which departments are responsible for initiating and approving such transactions, and the final payment. For some companies, what we've also done is create a checklist of government payment, which is inventoried by each level of government. This should give you almost every possible payment that could be made for a particular government and government entity, and then you can then determine which of those applicable payments would apply for your specific company. The second step I would recommend is to do a verification of the company's existing vendor database for all payees currently in existence and map those government payees to the payments identified in the life cycle you just did in tip number 1 by using some sort of master vendor list or a company's accounts payable master file. We call this, again, a completion of an identification of the government payment universe. Tip number 3 would be special consideration needs to be given to payments made to governments and payees of foreign jurisdictions, as well as understanding that there may be some confidentiality or specific legal considerations that need to be taken into account here. For example, for certain African and Asian countries, they have specific state secret laws which prohibit the disclosure of certain royalty payments as they threaten national economic or society best interests. Careful consideration and discussion with internal legal counsel and possibly with external or foreign legal counsel or other advisors is an important step for any companies with foreign assets and our companies.
Great, thanks, David. So another question, the Act talks about a substitution clause, and we talked about the fact that other governments will perhaps be implementing similar rules in other jurisdictions, like the UK example. So how does a company reconcile these regulations with other jurisdictions to Canada's Act?
It's a good question, Scott, and a common one. The problem is, I guess, and the easiest answer is it depends. The real answer is it goes back to the planning step of identifying every country a company is doing business in and making sure the stakeholders, such as in-house legal departments, external advisors, and country managers are involved up front. A comparison of the country's regulations in the foreign jurisdiction to the Canadian legal requirement under ESMA is the critical first step. So knowing what is the same and what is different will be key to informing the minister and for the minister to who will eventually provide compliance on whether or not that substitution report will be allowable.
Okay, thanks. So what processes do you think a company would be putting in place to report these payments properly?
Yeah, so we think that, right now that ISMA is going to be more of a continuous process rather than, say, a one-time project. The basis of that is because payments today will not be the payments you make tomorrow. As we know, government legislation is constantly changing. Taxes are constantly in flux. So we need a continuous process to identify payments being made or stopped both today and in the future. Typically, businesses already have existing processes and internal controls in place at a company to how the payments are initiated, approved, and recorded. Companies have procurement processes and accounts payable processes, which is a very good starting point to leverage on for ESMA. What needs to be changed, though, is the identification of any new payments to governments or Aboriginal groups, and those need to be eventually identified and put into the ultimate report. As was noted in Stacy's section, if a company was going to have the report audited, an understanding of the internal controls, as well as any internal company policies which initiate, approve, and record those payments, will need to be documented and tested each year. Not only are these procedures and processes open for review by the minister, by the powers within the Act, but without this, the audit process becomes a lot more cumbersome and a more substantive-based approach may be required if the audit is going to be selected.
Right. And do you think that companies should start to prepare for the Act, implementation of the Act early, and how can PwC help organizations prepare?
So based on similar projects where there's a regulatory compliance, getting ready for ESMA reporting can take longer than expected. We've seen this in other compliance projects as well, especially with organizations with international operations. Therefore, early start is best. One easy way to do this is to incorporate ISMA as part of the accounting and finance year-end reporting calendar. Many companies already do this in terms of their year-end reporting, so incorporating some sort of disclosure requirement for ISMA would be a good starting point, as well as allocating tasks and making the responsibility to individuals to accumulate these payments up into the reporting deadline is an important step so that deadlines aren't missed. Starting early will help companies that will have gaps in the identification of certain payments, time to ensure that processes and procedures are changed accordingly to accommodate the completeness of the project. Using an advisor like PwC who understands not only the Act, but the people, processes, and systems of your industry would be beneficial for such a compliance project. As Stacy commented, even if companies decide they don't want an audited report each year, the report still has to eventually be auditable as per the Act and at the Minister's discretion. As well, to fully utilize a due diligence defense, we recommend starting early to avoid last-minute surprises and then making sure that everything is fully documented as required.
Great. And what about the deferral for Aboriginal groups? How would that affect a company's preparations for reporting? And do you think companies should prepare for that requirement now or wait until the effective date?
Right. We've given this some thought, and because certain questions still remain unanswered around their Aboriginal payments, such as are payments made in the normal course of business that are made to, say, Aboriginal companies that may have like construction companies for building roads to a plant or well site, or how are corporate social responsibilities payments going to be handled. I think it might be early days, but what we would recommend is that because the processes for payments and identification would be very similar to the government process, we recommend that that be started at the same time. This would eliminate maybe doing certain things twice.
Great. So let's assume the company has completed all those steps and is now ready to report. Are there any key final steps to reporting?
Yeah, I think there's 4 key things that you should be focusing on. The first one is ensuring that the designated officer of the company who is responsible for reviewing and signing the final report has ample time to review this and ask questions, including time for questions for the auditor if one is utilized. The second is ensure the company's website is prepared and tested to post the report as required within the 150 days. Third, document retention and access to the minister for books and records is stipulated in the Act. The powers of the minister to review documentation regarding any payment is very extensive and broad. In fact, one of the rights of the minister of the 10 listed is examining anything in place of business, including any document. I don't know if there's anything that can be as broad as that, but that's what the current powers is. Finally, there's retention requirements for documentation for the preparation of the report, which has to be 7 years after the date of the report has been issued. And finally, as in every project like this, we would recommend a post-mortem review of the annual reporting process to determine if there's process improvements, how payments can be captured quickly so that completeness can be assured. All right. I'm going to turn it over now to Kelly. And Kelly's going to walk us through, her section on ABC and how that can be applicable to a project such as this. Kelly?
Thank you, Dick. The Canadian Foreign Public Officials Act, also known as the CFPOA, and other similar regulations, such as the Foreign Corrupt Practices Act in the U.S. and the UK Bribery Act, aim at deterring bribery and corruption. The Extractive Industry Act is one of the areas of focus for the enforcement of the CFPOA, in part due to the perceived risk of bribery and corruption in countries in which this industry operates. We have included the 2014 Corruption Perception Index map prepared by Transparency International for your reference. Transparency International is a non-for-profit organization that rates countries based on their perceived level of corruption. The darker the red on the map, the higher the perception of risk in the respective country. Similar to the Transparency Act, penalties for noncompliance to the CFPOA range from significant fines to criminal charges. Under the CFPOA, it is an offense to directly or indirectly offer or agree to offer any benefit to a foreign public official in order to obtain or retain an unfair advantage in the course of business. Penalties include unlimited fines for corporations and up to 14 years imprisonment for individuals. The Act applies anywhere in the world if the individual is a Canadian citizen or a permanent resident, or if the entity is formed in Canada. The recent conviction of Nazir Karigar illustrates the enforcement of the Act. Mr. Karigar was acting as an agent for a Canadian company based in Ottawa and owned by a U.S. entity. Mr. Karigar made admissions to having offered to pay bribes to Indian public officials in order to secure a winning bid on behalf of the Canadian organization. Mr. Karigar was sentenced to 3 years of imprisonment in Canada. It is important to note that the CFPOA also includes a separate offense for concealing bribery in an entity's books and records. There is an expectation of full transparency in an entity's books and records for both monetary and non-monetary transactions with foreign public officials. Directors and officers may be held liable for failure to exercise due diligence in monitoring the corporation's activities and preventing the occurrence of bribery and corruption. For instance, directors and officers can be liable if found guilty of ignoring red flags with respect to problems with internal controls or doing nothing to ensure that financial reporting mechanisms are in place. Directors and officers have a duty to exercise reasonable care as well as perform their fiduciary duty to public companies. When assisting clients with the implementation of an ABC program, one of the first questions we are often asked is, what constitutes a foreign public official? This definition can be quite broad, as it includes any officer, employee, or person acting in an official capacity. Examples to consider are foreign government officials, government-owned or controlled entities, political parties or political party officials, members of the military or the royal family, candidates for political office, any government department or agency, public international organizations, and officers or employees of a public international organization, such as the International Monetary Fund and World Bank. In April 2008, the RCMP established 2 international anti-bribery and corruption units focused on the enforcement of CFPOA legislation, and the number of investigations has increased significantly since that time. With an increase in the number of Canadian companies with operations abroad and a growing number of RCMP investigations into alleged bribery and corruption situations, it is important to address the requirements of Canadian CFPOA compliance. Requirements of compliance is usually addressed through an anti-bribery and corruption program. These programs typically have 3 main components, the first of it being policies, the second is the implementation of processes and controls, and the third being monitoring of such processes and controls for compliance, and continuously evolving the program. Policies which we usually recommend be reviewed, updated, and or developed as part of an ABC program include the company's code of conduct and business ethics, anti-bribery and corruption policy, if one exists, the company's delegation of authority, whistleblower policies and mechanisms, travel and entertainment policies, and other policies which deal with ABC compliance sensitive transactions such as gifts, hosting, sponsorships, and donations. In implementing a program, a company needs to understand where the risks of ABC reside, from a geographical perspective as well as interactions with government officials. This is usually done through a risk assessment. Once the risk assessment has been performed and policies updated, typically training is rolled out to employees, business partners, agents, and other representatives of the organization. Key processes such as procurement, accounts payable, HR processes for hiring and onboarding are also reviewed for compliance. Processes and controls over maintaining adequate books and records, and internal controls over financial reporting are also key elements of such a program. Once the program is in place, monitoring can be achieved through internal or external audits or a combination of both, and regular updates are provided to management and the board as part of good business practice and governance. The program should be reassessed on a continuous basis, taking into consideration changes in processes, operations, structure, or company or countries in which the company operates. For those of you who already have an ABC program in place, and for those of you who are contemplating the implementation of such a program, there are several ways in which such a program can be leveraged for compliance with the Transparency Act. Starting with the information gathered as part of the risk assessment for ABC. As part of that risk assessment, you will have determined company structure, where are the entities that you own, what joint ventures are you participating in, countries in which the company operates, what government interactions are in place, what type of government payments are being made, as well as who are the third parties that represent you. These can include agents, contractors, vendors who act on behalf of the company. Leveraging internal controls in terms of making sure that we have controls over the recording of applicable payments, as well as the accuracy, completeness, and timeliness of the recording of such payments. And leveraging current reporting mechanisms in place, as well as validation of compliance, which is being performed through internal and external audits. Thank you. So now I will return this to David.
Thanks very much, Kelly. And thank you very much to Scott, Stacey, and Kelly for providing us their perspectives. We want to now move to our Q&A component. So as a reminder, type questions into the Q&A window on the lower left-hand side of your screen, and then hit Submit button. We've already had several questions already submitted, and I want to be cognizant of time, so we're going to do our best to get through these questions. So I'll go through these questions and try and direct them to the appropriate presenter on an answer here. The first question we had was whether or not it is a requirement for XBRL to be used as the final report. There has been some discussion around using XBRL. It is not required. I think most companies are going to be just filing the report on their website in a format that looks closely to the one that Scott or some sort of similar format. The second question we have is in relation to the $100,000 limit, and Scott, I think, is going to handle that one.
Yeah, so this question was really about whether what level of payments has to be reported. And the Act addresses this in Section 9.2. Basically, it talks about reporting payments made within a category of payments that are made to the same payee if the total amount of all those payments during the financial year is at least A, the amount prescribed by regulation for that category of payment, or if no amount is prescribed for the category, $100,000. So we expect that likely cumulative payments to any one payee by category over $100,000 would likely be required. But again, this will be a key aspect, I think, of a company's tracking, so that it appropriately tracks all payments to be able to see if, in aggregate they fall over the limit, because it is quite a low payment threshold.
Good, thanks. Our next question is, will the reporting be on a cash or accrual basis? I think the Act makes direct statement about payments being made. Therefore, the expectation and our understanding is, from discussion, is that this will be reporting on a cash basis.
Yeah, so the one thing to watch out for there, too, is that it also, when we say cash basis, it also covers, the Act also covers payments in kind. So again, payments in kind during a year, in some cases, would have to be reported.
Let's see. Our next question is...
I think it was about the example of where we got the coming into force in June 2015.
Correct.
So based on our understanding, the Act will be proclaimed to be in force in June 2015, but the question was about whether it's possible that they'll try to align the reporting requirements under the Dodd-Frank Act in the U.S., which have been delayed with the Canadian effective date. And it's a good question. I mean, the latest that we understand is that it'll be declared to be in force in 2015, with then the reporting for a calendar year company required for the calendar year of 2016. But of course, this is just an expectation, so it may evolve over time, and that's clearly something to monitor because that could change the timeline. But based on the commitments that the Government of Canada has made internationally, we do think that it's likely that the 2016 calendar year will be the first year of reporting for a calendar year company.
All right. We had another question about confidentiality and about payments to acquire properties from a competitor's standpoint. Do these need to be reported? I think from our discussions with stakeholders and with government groups, they are sensitive to that. So I think companies need to give this careful consideration, but you do have the options about how certain payments are grouped according to projects. So that is at the company's discretion. And so, we would encourage companies, to bear that in mind so that, confidentiality or competitive advantages wouldn't be lost as a result of this.
And finally, I guess there was a question about materiality and whether the Act has any materiality threshold in it. Our understanding is there's the discussion about the level of reporting of payments, which we went through in an earlier question, but there's no specific materiality threshold cited in the Act itself. So it'll be interesting to see if there's any further discussion of that by the Ministry of Natural Resources. But as of now, there's no official materiality figure stated in the Act, other than the thresholds for the cumulative payments to be reported.
All right. Thanks, Scott. I want to be cognizant of time. There is one last question, and I think we've had it at least 10 times, was about the slides themselves. And we also weren't able to get to all the questions. So what I think we'll do, we have all the attendees that have signed up, and we will send a copy of the slides to each and every one of you. And then we'll also, as a follow-up, we'll try and group the remaining questions, because I know a lot of people have a few more good ones here that we'd like to address. And we'll do a Q&A slide as well as a follow-up to all those. So thank you very much, everyone. This concludes our presentation today. I want to thank all our speakers for sharing. I also want to thank each and every one of you for taking this time and being with us, and those who are submitting the questions. And we look forward to future discussion of this. And thank you very much for participating, and have a great day. Thank you.